Please subscribe, like, and hit that notification bell. Thanks, guys. All right, guys. So I decided to look back at the initial claims, so initial jobless claims, and I think this chart is more meaningful than the unemployment and all these other metrics where there's some type of debate on do people have 2 jobs, 3 jobs, or like whatever. And when I look at this chart, I saw, like, when you look at all charts, then eventually you kind of see, hey man, this chart looks like that chart or that ratio. So right now, just look at, this is the initial jobless claim since 1967. And I kind of thought that this one looked like my total debt saturation chart, the one I covered with on Tom with the Palisades Radio, and I think I did a tweet or 2 on it. So I'm just going to show you that. Bam, here it is. Here is my total debt. So this is US total debt multiplied times the Fed fund rate, so total saturation debt. So for guys who haven't followed this, every time the total debt times the Fed fund rate gets too high, there's a cleansing, and that has to unwind. It goes too high, cleansing, too high, cleansing, too high, cleansing, too high, cleansing, too high, huge cleansing. And this one here is a 2000 dot-com bubble. This was a 2008 crash, and that brought the cleansing back to 1970s types of levels. Doesn't mean that there's less debt than here. It just means that the total debt saturation is less. So even if there's huge debt, the rates are so low that it's sustainable. And look at that. Then after that, went all the way up. What's this? That's when gold bottomed. This turned down, and the total debt had another cleansing right here. And after that, we skyrocketed back up after March 2020. So now, as the rates are climbing and the debt is still high, this thing is peaking once again. So first thing I do is I want to see, okay, look, kind of tracking. But what I noticed was, while this tracked, one of them is leading, guys. One of them is leading. So right now, the total debt multiplied by the Fed fund rates. So the total, what I call the total debt serviceability saturation levels, is at all-time highs right here, where previously things cracked, right? I'm going to show you the drawings I put. Bam! Doo-doo. I don't know. Here's 12 months. Here's where we are today. I'm going to zoom in here. Here, what I did, I pretty much at the peak where this started rolling over. 12 months later, huge peak in jobless claims. So there's like when the total debt saturation saturates, and by the time it starts rolling down, then the effects are felt. And somewhere 12 months, 6 months after that starts rolling down, there's a huge issue in jobless claims. Put it here. So here I have a counter. Even here, like, the jobless claims are starting to rise. Maybe here in 2023, something horrendous is going to happen, just like in March Madness. Let me zoom back here, 2008. As this thing was peaking, 12 months later, jobless claims just went up and up and up. And we know what happened here. This was, jobless claims were going up before the crash, right? And then here in October 2008, that's when we had the crash, and jobless claims went up higher. When there's peak or peak low, like let's say there's a valley in something, always people look down. But when I see something that's on the floored low, I don't look down, I look up. And when people are going to see the jobless claims spike up to crazy levels, or even here in March 2009, jobless claims, astronomical levels, then you have to look for some TA to see, okay, maybe this thing's going to unwind, right? And then you look at debt saturation levels, and then you see that they've reset to like 1960s, 1974 levels. So then this is the weight of evidence. So you could think, okay, maybe the worst is behind us and it's time to go long, whatever, right? But it's going to be hard because in the media, when you see these spikes in initial jobless claims, it's going to feel like the end of the world. So let's go to 2000. Debt saturation level starts rolling over. Market's telling you there's too much. Jobless claims, what they do, they go up, up, up. That's the top of the dot-com bubble. Then as that unwinds, gold, silver did very well. Here in the 1990s, there was another one. Total debt saturation starts rolling over. What happened? Jobless claims, they kept going up and up and up. This is another one here. 1981. Here, the orange line right below the jobless claims. It's because I zoomed out, guys. What? Here you go. Jobless claims start spiking up while there's a rollover in the total debt saturation. Here's another one. Total debt saturation rolls over, spike up. Here in the 1970s, same thing. Total debt saturation as defined by US total debt multiplied by the Fed fund rates starts rolling over. What happens? Jobless claims, you just go through the roof. Same thing again here, peak, and then after that thing starts going up. All right, so what else did I get from this? Well, when I saw this, again, other charts I did, I said, man, this looks exactly like when we had US recessions. So here are the US recessions as defined by the Fed. And look how well they track, guys. Look how well this tracks. If I could stop moving. Okay, if I do this, it's going to stop. So right here, as this rolled over, pretty much after that, they declared this was a recession right here, that period. So the recession ends pretty much when the initial jobless claims peak. So if you wait for that to say, oh, there's a recession, the initial jobless claims are high, that's probably the end. The recession actually starts when the total debt saturation starts rolling over. You see it right here. Recession ends pretty much when the initial jobless claims peak, but the problems markets start pricing in the problems on the breakout here. Same thing here in the 70s, rolls over, recession overlaid. Here's the other one here that I just mentioned. Here's the other one. Look at that, how it matches. The overlay of the recessions and the time as that rolls over with the initial jobless claims going up matches pretty much. Another section right here goes up, rolls over. The green overlay, guys, is the recession. The 90s, the 2000s. Recession declared in that portion right here because of that two GDP quarters, but the hardship and the market going down is priced in ahead of time, right? But these are it's like a trifecta of information telling you that this is the cycle we're in. Here's another one, 2008, recession all the way declared here. Look where the recession peaks. It peaks pretty much when there's peak initial claims, when you think it's the end of the world. And that's when the total debt saturation bottoms, actually. And here is March Madness. That started rolling over, and we had here, you could barely see it, but that's the recession we had right here. And when did the recession end? Pretty much when the initial claims peak. All right, guys. So here is where we are today. We're back at this historical level here. I'm going to draw a trend line. There's one right here. Look at that, guys. I'm making that thicker. Thick. Look at that. We're back right here. So this is an area where you have to think that now the Black Swan event is baked into the cake. This is a ticking time bomb. Don't know when, but eventually this is going to start flattening out this curve. And when it starts turning down, then it's full-fledged recession officially as that goes down. But the market will have started pricing that in already, right? Ahead of time. And then the initial claims, remember when at the bottom, that's when the market starts pricing in the problems. And when it peaks, the pricing in of the problem is done. Now it's going to be us to ride the up. So this is telling me a couple of things. This is telling me that there's still fuel for markets to go down. Until this spikes, the initial claim spikes and goes down, the market still has room to go down, guys. And until this rolls over and bottoms and the total debt saturation flatlines back to these low levels, back to this, could even put this on here. Look at that, all the way back to 1970s. Until that goes back all the way down to these levels, the market still has to go down. Please subscribe, like, and hit that notification bell. Thanks, guys.